What's going on, guys, and welcome back to another video. So today I thought we'd do something a bit different, and I put up a poll asking what you would like me to discuss, and the winner here with 54% was 5 tips on what I've learned since starting investing. So today's video will be all about that, and hopefully at the end you'll be able to get some tips and tricks which will make a big impact in your own investing. And with all that being said, let's dive right on into today's video. So firstly, just a quick synopsis if you're new around here. I've started investing about a year ago, and we can kind of see the timeline here on my Trading 212 portfolio where I began about this time last year. As it stands, we have just over €9,500 in my portfolio, and we're up €1,207 or 14.68%. Now, definitely along the way, as I've kind of learned it myself, I've definitely picked up a lot of tips and tricks that I wish I knew when I started investing. So hopefully today you might be able to gain some benefit or knowledge from this as well, and maybe not make the same mistakes as in most beginner investors do. So in no particular order, the first one up is picking a broker is key. Now this might seem self-explanatory, but you'd be surprised how many people fail at the first hurdle. Now, definitely as a new investor, in most situations, you won't have a lot of capital at play, so you need to find a broker that's commission free. And that situation, that's why I picked Trading 212. Now, there's no referral links here or anything like that. That's just my broker of choice, because when I started investing, there was no fees whatsoever within this portfolio broker. Then I also have DeGiro as well. There's slight fees there, about 50 cents per trade. And again, this is minute in comparison to some of the bigger, well-known brokers that will certainly eat up your profits if you decide to go with them at the beginning. Now, also picking a broker that is cheap and commission free is definitely a huge factor here. However, you need to ensure that you're protected as well. And with the likes of Trading 212 and DeGiro, you're protected up to about 85 to 100,000 euro / GBP, depending on what broker you use and where your residence is of living. So again, that's definitely a key factor here. And again, I also have numerous brokers. You shouldn't just hold yourself to one, especially once your capital begins to grow. For example, I stated in prior videos that once my Trading 212 portfolio gets to 10,000 euro, which it's nearly there now, I'm going to start transferring capital into DeGiro, which you can see we have a massive €6 at the moment at play. So because you can have more than one broker, this will definitely give you better features, because as you know, different brokers have some benefits and disadvantages in comparison to one another. So by having a few, you kind of get the overall basket, which in my opinion is of great benefit. Now, the second tip is that diversification is key. Again, another kind of self-explanatory point, which you'd be surprised how many people actually disregard this and just go all in on tech or all in electric vehicle sector, like a lot of people have been doing, especially when the sector is actually booming. But if you're a long-term investor like me, you need to be invested across the board, because as you know, different sectors react differently to different market conditions. So by having an overall view, we can see even here on the left some of my pies that I have, everything from communication services to healthcare, financials, etc. I even have my overall ETFs as well to give me a vast diversification across the board. So in my opinion, that's a very important rule as well. And the second reason why I believe diversification is key, the first of these is obviously protection, which is one of the main investing rules, is to always be diversified to be protected against risk. But the second of these, which we'll discuss later on in another point as well, is that it gives you opportunities to buy in to dollar cost average if a certain sector is down. Just as an example, let's say tech is booming, well, you can park that and leave it ride. Whereas let's say consumer discretionary was doing poorly, well, you can kind of start loading up on your shares there as well. And then vice versa, in 6 months time even maybe, it could go the opposite way around, where tech could be failing and you could start pumping capital in there as well. So that's a very important point. And again, you're actually be very surprised how many people overlook diversification, because at the moment I have about 33 holdings, which some might say might be too much, some might say too little, but there isn't any magic number as such. But in my own personal opinion, and this isn't financial advice, you should hold at least a minimum of 10 different holdings, especially if you're a long-term investor. And that leads us on to the third point, that you should not panic when your stock is in the red. Now again, I'm part of a lot of groups on the likes of Facebook, etc., where a lot of new investors congregate to give ideas and advice. And again, you'd be very surprised at how people start panicking, even if the position is down 1 or 2%. You need to realize that as a long-term investor, this is going to happen. In fact, it has to happen for the markets to be healthy. And here, for example, the iShares Global Clean Energy ETF, my position is currently down over 10.5%. The dotted line here is my average price, and you can see it's currently trading about £9 and 5 pence. Now, in a lot of situations, people will kind of panic sell here because it is continually going down in value. Again, not by a whole lot, but it is slowly going down and down. Now, most people would start panic selling here, and the only reason you lose money is when you actually sell. So, in my personal opinion, what I've learned along the way is the dollar cost average in. So, effectively, buying small amounts of capital or funds as drops down and give me an overall cheaper average cost. So, eventually, when it does bounce back or when it starts to recover slash consolidate, you'll be making more of a profit. And just a side note as well on point 3 is that you should not lump all your capital in at once. For example, this ETF is down 10.5% at the moment, and let's say I had €1,000 free capital at play. Well, you shouldn't just lump it all in at once because it can drop more in value. So in my opinion, if you had €1,000 in this example, I wouldn't be putting more than €100 in at any given time. Give it a day or two or even a week, leave it breathe. If it goes down in value even further, well and good, you're going to get in at a cheaper cost. And if it goes back up in value, you win. It's a win-win situation either way because that means you're actually making more money that way as well. So definitely that's a main rule here, to diversify, to dollar cost average, and also to be able to have capital free to take advantage of when your stocks go down in value and to drip feed the funds in, not to lump it all in at once. Point 4 or tip 4 is be realistic and set goals. Now you'd be surprised as well when I tell people that I'm up, let's say 14.7%. Again, people that don't invest, they'd be like, oh, that's not a whole lot if in return, but it actually is, especially over the long term once you start compounding this as well. So some people, especially beginner investors, because they look at a lot of YouTube videos and even things like the Wolf of Wall Street as an example, and think if they invested €1,000 today, that by the end of the week they'll have 10 to 20,000. So it's not like that at all. It can happen if you buy penny stocks, which is extremely volatile, and you can lose all your money with the snap of a finger. So especially if you're investing in blue chip stocks, again, this will lead on to point 5 later on as well. But if you're investing in blue chip stocks, you can't expect to become a millionaire overnight. It's all about slowly drip feeding funds in and slowly getting profit and compounding that over time. But certainly, this style of investing that I currently do, to dollar cost average into 33 blue chip companies, you won't become a millionaire overnight. You'll make money, but it won't be anything substantial. But again, it's kind of a given once you hold these kind of blue chip companies and once you're diversified and buy in at the right time. Over the long term, you'll be making money. Now, as well, setting goals is key, just like anything else. For example, if you wanted to run a marathon, you need to have a start and end goal and how you're going to get there in between. So, for example, on this channel, I've said in a lot of my prior videos that I'd like to have €100,000 invested in the market. So that's my end goal as such. So we're nearly 10% of the way there at the moment. And it's great to have an end goal because it kind of keeps you focused and it really does make you save money. And even though you're investing it, it's technically saving it as well. Because since investing, if I didn't invest this €9,500 when I did, I'd probably have spent it on pointless things that I'd have nothing to show for it right now. So investing, although you make money from it as well, you actually use it as kind of a savings fund as such, especially if you have blue chip stocks. And my 5th tip is one that a lot of people have lost quite a lot of money from, and that's following hype. And in particular, let's say the likes of some of these cryptocurrencies and a lot of these kind of newer cryptocurrencies that are on the market. Sure, a lot of people have made a lot of money quick here, but as well, a lot of people have lost money, particularly the new investors. So for every winner, there must be a loser. And in this case, it's mostly new investors. So again, it mightn't be as fun as, let's say, buying into 100x penny stocks. And again, I'm not calling anyone out here in particular at all. In fact, those are the kind of videos that do get a lot of views. But again, if you're looking for realistic long-term goals, you should kind of stay away from these 100x penny stocks because most of the time it's kind of pump and dump. And again, you can make money either way here. You can make money quick by when it's going on its upward trend, or you could also short this stock, which will make you make money as well if that stock fails. But again, as a long-term investor in blue chip companies, boring is actually very important. And again, if you want to kind of have fun, you can kind of just get €100 and go out on a night out. So you should really use this investing money as a kind of boring way to make money because long term, boring and consistency is what will make you the profits. So in a lot of my prior videos at the start of the weeks when I discuss what stocks I'm buying this week, a lot of the time it seems repetitive and slash boring. Although again, this is what makes money long term is consistency and kind of boring, kind of tipping away at stocks that are doing poorly at the moment that you know will bounce back eventually and make you bigger overall profits because you got an overall cheaper average cost. So in a lot of prior videos you saw I bought the likes of High Tide and the iShares Global Clean Energy ETF and Tesla as well as of late. Now I'm buying those consistently, small amounts. Again, it just goes back to point 2 or 3 I believe, in terms of not lumping all your capital in at once, slowly drip feeding funds in, because that way you'll get a better overall average cost and giving you a bigger profit long term. But again, just to sum up this point as well, boring, again, a lot of times new investors are eager to make money, and I was too, especially when I started investing first day. I think I bought and sold stocks, literally the exact same stock I bought and sold a few times at the start, because it was the kind of fear of missing out as such. And although that seemed good at the time, looking back it wasn't at all. You'd actually lose money, especially if you pay commission on a lot of brokers. So slow, consistent, boring is actually the best way to make money in this market. So again, in summary, my 5 tips for new investors or even kind of more advanced investors that are looking for some kind of tips is: firstly, be realistic and set goals. Second, don't panic and buy dollar cost averaging your stocks when they're in the red. Third is diversification is key for protection and also for be able to dollar cost average into different funds. Fourth is picking the right broker, as brokers that charge fees will really eat up your gains, especially if you have small capital. And the fifth point that we covered last year was that boring is good and you shouldn't follow hype. So I hope any of these kind of tips today helped you going forward as an investor. And if so, it'd be great if you could smash the like button. And if you're new around here, it'd be great if you consider subscribing as well, as we're kind of getting closer now to the 1500 subscriber mark. So thanks very much. Enjoy the rest of your Tuesday, and I'll see you all in tomorrow's video.